Welcome back to the channel, where we demystify the complex world of finance, especially when it comes to those elusive hard-to-borrow stocks and the mechanics behind a short squeeze. Today, we're putting a unique company under the microscope, the GrowHub Limited, trading under the ticker TGHL. This stock recently triggered our screener for its exceptionally high cost to borrow, making it a fascinating case study. Before we dive into the specifics of TGHL, please remember this. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's get acquainted with the GrowHub Limited, or TGHL. This company operates in the technology and software infrastructure sector with a current market capitalization of $23.01 million. TGHL isn't just a tech company, they're an investment holding company providing critical product traceability, data analytics, and product trading facilitation solutions primarily in Singapore and internationally. Think about the importance of tracking products from raw materials to the final consumer. That's the kind of infrastructure TGHL is building. Now let's look at recent price action. TGHL saw a minus 9.25% change today. However, looking back just slightly further, it's up plus 13.15% over the last 5 days, then a significant plus 52.76% over the last 30 days. This volatility can certainly catch attention. As for volume, today's trading saw just 137,800 shares change hands, which is a stark contrast to its 30-day average volume of 10,001,120 shares. This gives TGHL a relative volume of 0x its average, indicating exceptionally low activity today compared to its recent past. What is cost to borrow and why it matters? So, what exactly is cost to borrow, and why is it such a crucial signal when we talk about short squeeze potential? Simply put, when investors want to bet against a stock, they short sell it. This involves borrowing shares, selling them immediately, and hoping to buy them back later at a lower price to return to the lender, profiting from the difference. But borrowing shares isn't free. There's a fee, called the cost to borrow, or CTB. This is an annualized interest rate paid by the short seller to the lender of the shares. When a stock becomes hard to borrow, it means there's high demand from short sellers and limited supply of shares available for lending. This scarcity drives the cost to borrow sky high. These can easily exceed 100% annually, meaning short sellers are paying over 1% of the share price every few days just to maintain their position. These escalating costs can quickly erode potential profits and even force short sellers to rethink their strategy. Why this stock is hard to borrow right now. This brings us directly to the GrowHub Limited. Our screener flagged TGHL because its annualized cost to borrow fee is an astronomical 773.1%. Highlight number that is an extremely high rate, signaling intense demand from short sellers to borrow TGHL shares and a severe scarcity in the market. While the exact number of shares currently available to borrow is unknown, a fee like this strongly implies that borrowable shares are incredibly scarce, if not completely depleted. TGHL's estimated float, which is the number of shares readily available for public trading, stands at 12.7 million shares. A high cost to borrow on a relatively small float can be a powerful combination. Our internal composite squeeze score for TGHL currently sits at 46.5 out of 100. This score incorporates factors like CTB level, borrower supply, float size, and price momentum, suggesting TGHL has some of the conditions for a squeeze, but it's not yet at an extreme level. It's important to remember that a high cost to borrow doesn't automatically guarantee a squeeze. It can also indicate that short sellers have very strong conviction about the company's future performance, and they are willing to pay a premium to maintain their bearish bets. Squeeze mechanics explained. So, how does this high cost to borrow translate into a potential short squeeze? Imagine hundreds of short sellers betting against TGHL, paying the staggering 773.1% annual fee. As the cost to hold their positions climbs, their break-even price rises daily. If, for any reason, perhaps positive news for the GrowHub Limited's traceability solutions, or even just some buying pressure, TGHL stock price starts to tick up. Short sellers feel the heat from both rising prices and the crushing borrow fees. This could force them to start buying back shares to close their short positions and cut their losses. When they buy, it adds to the upward price pressure, creating a feedback loop. Other short sellers see the price rising, their losses mounting, and their borrow fees eating away at their capital, leading more of them to cover. This cascade of forced buying can lead to a rapid and dramatic surge in stock price, which is the essence of a short squeeze. A smaller float, like TGHL's 12.7 million shares, means fewer shares are needed to create significant price movements. Today's very low relative volume for TGHL suggests we're not seeing this squeeze action today, but the underlying conditions from the CCB are certainly noteworthy. Dilution risk check. One critical factor that can make or break a short squeeze thesis, even with high cost to borrow, is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This floods the market with more supply, making it easier for short sellers to find shares to cover their positions, and it can significantly depress the stock price, effectively negating any potential squeeze. For TGHL, we found no recent dilutive SEC filings -1/-3/424B in the last 90 days. This is a positive sign for any potential short squeeze scenario, as it means the company isn't currently adding new shares to the market that could ease the pressure on shorts. Furthermore, we also found no recent reverse split for TGHL in our look-back window, another factor that can sometimes impact short positions. Again, a quick but important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For TGHL, given its unique profile, here's what you'd want to keep an eye on if you're tracking its short squeeze potential. First, continued high costs to borrow fees, ideally with an indication of further decrease in shares available to borrow. Second, a significant increase in trading volume, something far above its 30-day average of 10,120 shares combined with strong upward price action. Third, any positive fundamental news regarding the Grow Hub Limited's operations in product traceability or data analytics could act as a catalyst. Remember, while the cost to borrow is extremely high, indicating a constrained supply for shorts, a squeeze is never guaranteed. Market dynamics are complex, and short sellers, especially with strong conviction, might be willing to absorb those fees. The Grow Hub Limited, TGHL, presents a fascinating case with its staggering 773.1% annualized cost to borrow, no immediate dilution risk, and a modest $23.01 million market cap in the technology/software infrastructure sector. While today's low volume suggests no squeeze is happening right now, the underlying hard-to-borrow conditions are certainly something to keep on your radar. Always conduct your own thorough due diligence, understand the risks, and make informed decisions. We hope this deep dive into TGHL has been educational. If you found this analysis helpful, please hit that like button, subscribe to the channel for more unique stock breakdowns, and let us know in the comments what other hard-to-borrow stocks you'd like us to cover. Thanks for watching, and we'll see you in the next video.